Welcome back to our Strategic Financial Reporting series. I am your host, Suresh Periyasamy, a CPA in both the US and Canada, and an FCA in Sri Lanka. Today, we are diving into the complex world of US GAAP. We're going to explore how to account for intangible assets, navigating through key standards like ASC 350, ASC 730, and ASC 805. Whether you are dealing with software, patents, or goodwill, this guide will give you the roadmap you need. Let's get started. First, what exactly is an intangible asset under US GAAP? By definition, these are assets, excluding financial assets, that lack physical substance. You cannot touch them. However, to be recognized separately from general business goodwill, an intangible asset must meet specific identifiability criteria. It must meet at least one of two tests. Test 1, separability. Can this asset be divided, sold, licensed, or transferred on its own? Test 2, contractual legal. Does this asset arise from a contract or a legal right, like a registered patent or a trademark? If it meets either of these, it is an identifiable intangible. One of the most common ways companies acquire intangibles is through mergers and acquisitions. This brings us to ASC 805, business combinations. When you acquire a company, all identifiable intangible assets must be recognized at their fair value as of the acquisition date. This includes unrecorded assets, like internally developed brands, which the target company previously expensed. You also capitalize acquired in-process R&D as an indefinite-lived asset. Once all identifiable assets are measured, any remaining premium paid for the company is simply allocated to goodwill. Valuing these assets often requires highly complex income models and Level 3 fair value inputs. Now, if you are working with a private company, US GAAP offers a major shortcut. Under the Private Company Council, or PCC, accounting alternative, private entities can elect to simplify their accounting for intangibles. Most notably, they can choose to amortize goodwill on a straight-line basis over exactly 10 years. They can also fold certain customer-related intangibles and non-compete agreements directly into goodwill, rather than valuing them separately. This drastically reduces the cost and complexity of financial reporting for private businesses. What happens when a company develops intangibles internally? Under ASC 730, the baseline rule is highly conservative. Most research and development costs must be expensed immediately as they are incurred. This prevents companies from artificially inflating their balance sheets with failed projects. However, there are a couple of exceptions. As we mentioned, acquired in-process R&D from a business combination is capitalized. Also, if you buy physical assets for R&D, like a general-purpose laboratory, you can capitalize those assets if they have an alternate future use for other projects.
Software development is the big exception to the R&D expensing rule, but US GAAP treats software differently depending on what you plan to do with it. If the software is for internal use under ASC 350-40, you expense costs during the preliminary stage, capitalize costs during the application development stage, and then go back to expensing costs once it is operational. But if the software is for external sale, under ASC 985, you must expense all planning and design costs until you reach technological feasibility. Only after that milestone can you begin capitalizing costs, stopping once the product is released to customers. Once an intangible asset is on the balance sheet, how do we expense it over time? That depends entirely on its useful life. If it has a finite useful life, like a 5-year patent, you amortize it over that expected period, typically on a straight-line basis. If it has an indefinite useful life, like a perpetual trademark, you do not amortize it at all. Instead, you leave it on the balance sheet and test it for impairment at least annually. Management is required to reevaluate these assumptions every reporting period. Speaking of impairment, US GAAP introduced a massive time saver known as Step 0. Before paying for an expensive valuation, companies can perform an optional qualitative assessment. You simply ask, based on macroeconomic conditions, industry trends, or company-specific events, like losing a major customer, is it more likely than not that the asset is impaired? If the answer is no, you are done. no math required.
If you skip step 0, or if you fail it, you must move to the quantitative impairment test. Thankfully, US GAAP simplified this into a single step. You compare the carrying amount of the reporting unit to its fair value. If the carrying amount is higher, you record an impairment loss for the exact difference. The only limit is that your impairment loss cannot exceed the total amount of goodwill allocated to that specific reporting unit. If you are familiar with international standards, you must be careful because US GAAP has several major differences from IFRS. First, revaluation. IFRS allows you to revalue intangibles if there is an active market. US GAAP prohibits this. You must use historical cost. Second, internal R&D. IFRS allows you to capitalize the development phase of any project if you meet strict criteria. US GAAP forces you to expense almost everything, except for software. And finally, US GAAP has entirely separate rules for internal versus external software, whereas IFRS handles all intangibles under one single standard. Ultimately, compliance comes down to disclosure. US GAAP requires robust footnotes showing aggregated and disaggregated views of your carrying amounts, 5 years of projected amortization expense, and detailed explanations of any significant impairment losses. Navigating intangible assets under US GAAP requires a deep understanding of multiple ASC topics. If you found this breakdown helpful, please hit the like button and subscribe. If you are a CPA candidate or a finance professional looking for personalized, one-on-one tutoring to master these complex standards, you can reach out to me directly at spadvisory.co@gmail.com. Thank you so much for your time, and I will see you in the next masterclass.